And the 0.6 applies to all of these, whether if we went to the diversified, moderate, where you said it was 6.9%, it would still be 0.6 less than that.
Say that last part again.
Well, I think the number you gave me for the moderate, they expected was 6.9%.
Well, moderate would be 6.4. Moderate aggressive, the last one.
6.4, would I subtract then 0.6 from that one as well?
Yes.
Yes.
Yeah.
So, do we have that report? Did they give that to us last month?
I gave it to you in a spiral like that, yeah, when you came to
Last
the
month
meeting.
or?
Yeah,
Last
last
month,
month.
correct. Mhm. If you don't have it, I'll get you another copy. I think I might,
All right.
I don't think I have it electronically.
Besides, something just doesn't sit right, and I can't figure out what it is.
No, I mean, well, with the fees though, you know, there's the, like he said, there's the embedded fees in the mutual funds, and then we have an agreement with PARS to be our trust administrator, and so there are fees set up for that cost.
And FARS is a division of PERS?
No.
They're
no.
completely separate.
It's a totally coincidental that the acronyms are similar.
Wow.
There's
Under the
nothing to do-
agency, retirement.
We wouldn't have done this if it had been
Who are
ours.
they? Independent
That's what we
firm?
went over last
Private
time.
label?
I'll give you my notebook when I leave, but they're, they've been
Greg
in
may not have been
business.
here last time. Was he here
Yeah.
last time? I'll pull for
I
minutes.
probably wasn't here
You
mentally.
know, They have
Well, he was
49
good.
years
Yeah.
of experience.
Yeah, you were
I'll
getting
give you
ready
my
to go.
notebook.
You had a meeting afterwards and you left, and I'm not sure if we covered this at the end, but you had a meeting up in San Mateo.
Out there
Greg ran for Senate.
US
running against Diane Feinstein.
And I ran against 11 Republicans, and I didn't do as well as I hoped.
Anyway, if I could ask a question.
Yes.
I've been trying to ask for a while. If you're in the active, okay. Many of these stock funds actually all have, a lot of them have very similar, if not the same stocks, maybe in different quantities and things like that. So as you're going through and you're active, if you were to go in the active, what type of analysis do you do? Do you make sure that they're not all, you're just buying multiple funds with the same
Sure.
stuff? Do you do an analysis of actually the active holdings?
Deadline holdings, you bet. It's probably, we have a 7-step process, and maybe around step 6 or 7, we're looking at the underlying holdings. But certainly, you can kind of get a flavor of some of the things that we think about or do when you see the colors on the, if you flip the page on the back.
I
of
see
it.
this here.
Yeah, so you're on the
Most of
page.
it is in long term, and it's what, a quarter of it is in really under active management, I would say.
Right, so what we try to think about is trying to be diversified amongst various asset styles and classes. So, size, large, mid-cap, small.
Mhm.
Styles, value growth, core. Certainly we think about international, we think about emerging markets, high yield. We think about our maturities, of course, from short to intermediate term to longer term duration on the bond side. So we want to be diversified under a variety of metrics.
All right.
We then, once we figure out where we want to allocate,
Mhm.
then we need some funds. And so we run a variety of screens using primarily Morningstar data we look at the assets of the fund, we look at the tenure of the manager, we look at fees and expenses that the funds are going to be charging. We look at the style consistency. We want to make sure that if we're buying a mid-cap fund, that they're not putting a whole bunch of small caps in there.
Okay.
So we look at a variety of metrics here. We have a team of 4 analysts that we give them the charge of sending out RFPs to all the fund families that we work with. And then once those RFPs come in, we go out and interview the fund families at their site. And we keep a constant dialogue going with the management teams. We're not perfect. We do change out of funds every now and then, probably on average 1 to 2 a year. Last year I think we moved out of 3 funds.
How many are you in?
Right now I think we have about 18 or 19 funds on the active side. We will be getting rid of one of the funds here, the Manning and Napier Fund, by the end of this quarter. So we do active reviews and active management of the funds that we invest in.
We're not claiming perfection either.
Yeah.
Have you had any funds go bankrupt?
Oh gosh, no.
No.
No. No. I mean
Because these are not leveraged entities, they're using
Yeah.
capital, not borrowed money.
Yeah. And so that's some of the thoughts that go into the various screens and the analysis.
Okay, all right, thank you. Okay, so then, and you have these in order, so the next one, you're up,
Hopefully,
you're about 50%.
I can't blame my
And then
assistant, I stapled it, so yeah,
Okay.
they should be in order of risk and.
Moderate is even less on your bonds.
Yeah.
About 2/3, 1/3, and then I guess you get a little more refined to about.
And just in
70.
case we don't come to a decision today, let me just sort of lay out how this page is set up if I can, in case you're gonna do research after the meeting. So on the right,
Which one are you on?
anyone, the first page of anyone.
Conservative.
Yeah, so take a look at the conservative.
Yeah.
On the left-hand side, you will see the actively managed platform, the ones that we have actively managed mutual funds. On the right-hand side, you'll see the index-based platform. The periods of time, and this is all ending March 31st, 2012. You'll see the quarter, year-to-date, 1, 3, 5, and then inception-to-date periods. Below that, you'll see the annual rates of return. So what did these investment objectives return in a calendar year, not fiscal year, but calendar year, so in other words, Jan 1 to December 31 for 2007, 2008, 9, and 10. And so a lot of committees will, they may think, oh, let's be ambitious and let's do that moderately aggressive allocation. And then they'll turn to the moderate aggressive allocation and say, oh, wow, it was down 25.8% in 2008. It does begin to frame some risk, of the risk and reward question.
Alan, according to this, the actively managed funds are doing quite a bit better than the passive index.
Well, let's see.
It's about a push. I wish I could come in here and say,
I'm
you know,
we
looking
beat them
at,
every year.
I'm looking at the
Yeah.
first page here.
Well, those active funds, sometimes they just get lucky.
Yeah, I'm just saying that.
So
if you
look,
at
for
almost all of them-
2007, indexed is better.
Can I tell you a little secret, what's in the secret sauce a little bit?
Yeah.
Yeah, we'd like,
He's looking at the first page, and the conservative allocation, we do have a bit better of a track record. We have a bit better track record primarily because of Bill Gross at PIMCO, and that's been a huge contributor on the fixed income side. And remember, the conservative portfolio is a whole bunch of fixed income, so if you really do well in that conservative space, and Bill's done well, and so has our high mark bond fund, it's done pretty well, that's carried the day. Now, if you go to the more aggressive, I mean, we still have exposure to the Bill Gross and the high mark bond fund, but it's less of a percentage. And so as you get a little bit more risky, our equity funds, specifically in the large cap area, haven't done so well. And that's, as much as the bonds have helped us on the conservative side, the large cap core has kind of held us back on the more aggressive platforms.
Well, Jim, apropos what you're saying, in 2008, the active lost 9.04, and the index lost only 6.7, so the index fund did better there.
I was just looking at the first page here.
2009, it looks like they were lucky.
Oh, I wasn't lucky. But we can agree to
after that, they're
disagree.
about the same, except
About
for
the same.
211, and 211 index is a little bit higher.
Right.
Well, I just.
212, I think.
If your interest rate's going to 3 to 4%, it seems to me these returns are really gonna tank.
You need and we need to think about that and talk about that in subsequent meetings. Because certainly you could start off, of course, and I should have mentioned this from the get-go, any investment objective that you were to select today, or maybe if you meet later on, you're not locked into it. We can change investment objectives pretty quickly, in a matter of days, not months and quarters.
And so I would like us to make a decision of how to get started, and then absolutely at our next meeting, we can look at it, and like you said, we can change it once we get more comfortable.
So are there in and out fees?
No, we don't charge you for anything for going, for changing one investment to another, and mutual funds we don't invest in load funds, so there's no back end, there's none of that. I would encourage you to have a little bit longer term horizon in mind when you select your investment objective. It is true that we can change investment objectives,
Well, no, I'm just asking, in your projection of a 3 or 4% return, did you factor in the decrease in principal when the bonds are yielding 1% today?
we have within that 5-year horizon, there is some of that built in, given our expected rate of return of 2 to 3%. There is some of that. We don't think the Fed's going to raise till probably 2014.
They're not gonna raise interest rates in 2014.
That's what the Fed says, and
Did you
they,
check with the Chinese?
if you give me the Chinese
I mean,
gentleman
they're
to
buying
check
the
with,
bond.
who
They're
knows
buying
the
the bond.
answer?
Do you think they're gonna sit around and pay and get 1% from now to
Well,
2014?
Well, the plain fact is it's uncertain, we don't know. I can just imagine we do something that really antagonizes the Chinese and they quit buying our bonds for a while.
I mean, I can tell I'm gonna like our annual or maybe even semi-annual meetings, and I say that with all sincerity, because I love
Discussion.
an interactive committee,
Yeah.
and I sense this is one.
What is it, Deborah, you want us to do today?
Decide how to-
What are your recommendations? You're recommending the moderate, what are you recommending?
Not to be a weasel, it is difficult for me to give a recommendation when you have a 4% target rate of return. So at some point, I would encourage the committee to do this. What do you feel comfortable with in terms of telling Nikolai, because you all are gonna have to tell Nikolai, here's our number. Our number's 5.5. Here's our number, 6%.
That's our actuary.
Well,
Yeah.
what is that?
You know, what is that? I mean, what risk, that's what we should take.
Well-
What risk we wanna take?
I'm glad you said that. I mean, you can come at it from, here's our number, and, here's the allocation that we want, or here's the risk, and what number does that equal? I gave you our projections, our best guess, and it is a guess, for a 5-year horizon, and I gave the committee that number. So looking at that number, and then looking at maybe historical rates of return, and then also given what you're thinking, well, they're gonna raise rates sooner, so, all this protection that we think we're getting in conservative allocation, I don't necessarily think we're gonna get in conservative allocation. Maybe we wanna go moderate or moderately conservative. I mean, all these discussion points should lead to, hopefully will lead to the committee saying, that's where we're gonna start.
Okay, but these are kind of portfolio designs with more or less standard deviation, right? And so it's not quite the same thing as what I was talking about, which is like you
No.
have a ladder, you always got some money in the bank, so that if the stock market really tanks, you can still pay your obligations without selling stock.
But as I said, you're 26 years away from really broaching the notion of having an immunized ladder type portfolio like that.
Mhm.
When I go around with my manager on that, because I wanna do ladders.
Yeah,
And he said, the ladders are worthless now because the rates are so low, but if you buy into a fund like Temco, whatever that is, and, they're yielding a higher yield, but you run the risk that if something goes wrong, you can't hold it to maturity and get your principal back, you have to suffer a principal loss. And that's why I asked him whether the principal loss in this projection is there.
it's a little bit like my defined contribution 401k.
Right.
And so I'm locked into, when the stock market really goes down, to meet their, required minimum distributions, they nevertheless have to sell stock into this terrible market. Remember Senator McCain saved us from that in about 2009, waived the required minimum distribution for a year.
Yeah.
That was a big support. But we don't have that here, that is, we're gonna have to meet these payments.
Well, I mean,
Yeah.
Well, we can pick,
The
the
idea is
conservative has more cash, so I mean, some of these have more, they do have the cash.
Well, I personally think that the bonds are more risky than the stock because of the interest rate fluctuation.
But if we wanted to have a set of minimums, cash value that we wanted to have to address Alan's, can we do that, or do we just buy in and then you guys do the
Well,
math?
you're gonna be in a pool
Yeah.
with 30 to 40 of your closest friends.
Yeah,
So we will have a targeted cash allocation for the pool, and currently, for the conservative it's 5%, moderately conservative is 3%, and moderate is 3%. I mean, it's
So
just.
we can't define.
You can't
We
define.
were buying, so we're buying like a meal plan, right? Okay, we
Yeah.
only have certain
It's such
things
an
that we can do.
unsavory description,
Okay.
but I know what you're.
Okay, so we don't have the flexibility to say, yeah, we wanna go conservative, we wanna go this, but we would like
We wanna
to have a
tweak it.
cash balance of 20%, something like that. We can't do that.
No.
Okay.
No, but we can set up our own cash balance in our internal service
Oh,
fund,
then
so
only
that
give
we
them-
never have to worry about
Okay,
that.
so then
We can still have that in reserve.
so we could say
within
just
our
take $1
balance
million.
sheet.
So we could say here, just put $1 million in there and so that's one,
Yeah.
so maybe we need to do that.
Yeah.
One of it is minimum is 20% in any of these.
I'm sorry, I asked her a question. Greg,
Your minimum cash, if I, somewhere. on it.
maximum is 20. The maximum.
Maximum is
Yeah,
20.
maximum, okay.
But
I like
minimum,
to
what's the minimum?
put, 0,
Someplace that's in here.
Well,
0 to 20 is the range.
well, just kind of, the way I think about it is it's not that, the percentage in the balance mix, you might say, it's just how much money do we have on hand so that if the Greeks and everybody else really go to hell over there and the market really tanks, we don't have to sell stock in that bad market.
Yeah, I would encourage you that these funds should be longer term in orientation, and even if we did have something like that, and over a 30-year horizon, we're gonna have some type of period like that. And so you definitely want it in the first couple of years if you're gonna have it, or when you're gonna have it. You don't want it when you're right at the finish line there at mile 24, mile 25 with one more mile to go in the marathon, and then all of a sudden, you get 2008 to whack you down. You do have, and Greg, you said a second ago, you said it a little bit different flavor, that you're worried about the fixed income risks. And so I think, I share that with a lot of my clients, that so much of the risks certainly are gonna be in the fixed income market over the next 3 to 4 years. Yeah, equities could get a haircut, or a big haircut, if something really bad were to happen in Europe, or something, with the fiscal cliff going on at the end of the year, or moving on to 2013 if they don't come together. But, if cooler heads prevail in Europe and we can get some type of extension, you'll see equity markets, snap back pretty quickly. So long-winded answer to, I'd encourage you not to think about the conservative allocation. I don't think that really gets you anywhere. Most of the clients I work with have selected moderate, but they do that with working with their Nikolai or their John Bartel, and usually 6 to 6.5% is what their discount rate is here. So I certainly, it's not within my role to say you should use 6%, because that's what everybody else uses. Not saying that, but if you're, think long-term, 6.5%, something like moderate, or even if you want to do moderately conservative.
Well, we can change every year, is that what you're saying?
Well, what I said is you can change more than you can change conceivably every
If we go
6
with moderate
months.
today,
Pardon?
if we go with moderate today and
Mhm.
we find that things are going to hell,
Yep.
we can, and anytime we can decide to change, is that right?
You can. So the honest answer to that question is yes, but I really would encourage you to have a longer term.
No, I mean, I'm
Right.
not saying we're going to do that, I just want to kind of get.
You have
a feel
flexibility.
for what is possible.
Yes,
We could
the
do
city
it.
manager has the flexibility and the authorization to go ahead and change the mix of funds.
So are we going to make a decision which one we go with?
To
or we can
change
start
the
sitting and
strategy.
talk about it?
Well, I think it shouldn't be a sole discretion on the part of one individual who may or may not be astute in financials.
City
So
manager
it's-
should have that right.
So
No,
it
well-
needs to be with the finance director, and I think either with the council or with the finance committee. Seriously.
Well, he can't.
Well, like, give it an example, I'm giving it to her.
So, just to be clear, so the council adopted a resolution that you have to assign a plan administrator,
Right.
okay? And so the plan administrator in ours is the city manager.
Mhm.
And so, of course, the city manager is asking for the advice of the finance director, but the city manager is the one that actually initiates those changes. And so is what I'm asking the finance committee is to provide a recommended strategy so that we can go forward. So I'm not,
To implement our recommendations.
to implement the recommendations
But he
made by
can't
the
turn around and
committee.
reverse it if he doesn't like what's going on.
No, but a strategy doesn't mean, a strategy gives a little leeway, right? Like when you adopted my strategy for the cities, the town's investment portfolio, we gave ranges where I can invest in commercial paper here and there. So I have some discretion. So is what I'm asking the committee to do is to provide some discretion, which may be you stay in here until the Fed changes something, you stay in here until we meet again. You know what I mean? You provide a strategy so that staff can move forward. And it can be a rigid strategy, or it can be a broad strategy that gives us some triggers
So the
that
strategy
we can
could
work
be,
on.
the strategy could be, the finance committee will meet and confer periodically and provide updated.
Yes,
Okay.
but I didn't want to
At
set it
least
up
annually,
so that
at
I
least
didn't,
annually.
absolutely annually, and I think that's written in here.
But it's still
And I
would
didn't
happen
want to
once
set it
the
up,
Right,
Yeah, we got a lot
that's
to
what
check, we
we
need
gotta
to decide today
Yes.
where we're gonna
Yes,
start.
and I
I'm
didn't
saying, I
wanna
don't
set
think
it
we
up
can
where
change
the
it without
city
going
manager-
backwards.
Yeah, and you wouldn't want to set up a process where the city manager couldn't take some kind of immediate action if there was something that the
Yeah.
investment advisor called and said, it would really be great if you moved to a different fund because this is going on. You don't want to have to wait to set
Well,
everything up to,
Well,
you
changing the
know.
fund is different than changing the allocation strategy.
I think I meant changing the,
Deborah, here's what I would recommend.
Hmm?
That the city manager will monitor what's going on. And should she or he decide that they want to make some changes, they would immediately call a meeting of the finance committee.
I agree with that, because,
Does the
you know,
Brown Act
there is,
prevent you from doing
there's
that?
a knowledge base that needs to be there. And, you know, I mean, if the city manager has never invested day one, maybe doesn't even read the papers other than the almanac, you know, then sorry, then, I don't see that they're making an informed decision. I agree that they're gonna get calls from Highmark and they're gonna say, hey, we really think you should move, but I do think that there should be at least some discussion. It doesn't,
we can absolutely put that into the strategy.
That would be my suggestion.
yeah,
That that where any apparent major changes are taking place, the city manager immediately calls a meeting of the finance committee.
Ellen, my gut tells me to go with moderate, because I'm just as fearful of the bonds as I am the stocks. And the conservative were 80% bonds,
I agree with you.
and I just think big risk in the next 2-3 years is interest rate fluctuation, and the bonds are gonna be clogged with red start going up.
Well, can we decide which one we're recommending to go with right
Well, I'd
now?
recommend moderate if people, as
Well,
a starter.
We're
if we wanna
going
change.
moderate, but then we have to say whether or not we want indexed or passive. We've already talked about passive, but I think we need to
I think-
get an agreement.
I think based on what Alan is telling me, I would go moderate and index. That would be my suggestion.
Moderate,
Okay,
what do you say now?
moderate index.
What's the difference here? What's the difference? They're pretty close.
Well, I heard Alan say, you know, first off, don't pick, you know, conservative because he really feels that that's not worth, you know, he feels that we should be a little bit higher, a little bit more aggressive. But I also heard you say that with all due respect, committee, I think that you'd be better at this point in time. There's more risk in the index, and he would recommend that we go active. That's what I think I heard you say, that you think that there's more security in equities as there is in
I
the bond
believe
funds.
that you get equal amounts of diversification, whether or not we're in index or whether we're in active.
Okay.
Now, of course, we're an actively managed shop, and we like to think that we can beat the markets. Some years we do by a whole lot, and some years we don't.
Well, when you say active, what is the difference between active and index? Are you,
You
Well,
the
you
index,
invest in these funds that have equities in it versus these funds that are
Yeah,
more
so,
bond focused.
Indexed is the dartboard. That is,
Well, it's a little bit better than that. It's a little bit better than that. I'm giving credit.
Yeah, so an index would be, let's take, for example, the S&P 500. We want exposure to the entire S&P 500 index. We are not trying to outperform that index. We don't want to underperform it by too much. By definition, we'll underperform it probably by just a smidgen because it is a very small embedded expense by any index fund. But we're comfortable with getting right what the market's going to offer.
well, my portfolio has index fund in each box and two active funds in each
So
box.
you're kind of a hybrid. Yeah.
It's, you know, cap, low cap, high cap, mid cap,
Yeah.
and then value growth, and value.
And that's similar to what we're describing here, only we have, on the right-hand side of the page, of any of the page 2 behind, right here, it's gonna be all a variety of index funds. So it's gonna be the international index fund, the emerging market index fund, a high yield index fund would be there too.
Yeah.
The S&P 500 is gonna be there. And the common denominator is we're trying to attain the return of those indices, and we don't wanna pay a whole lot in terms of
Well,
management.
why don't you have because that's what I do, I have one in the middle. I take
Well,
one
very good.
index and 2 of the active one, each risk profile, and you don't give us that choice, is all I'm saying.
Well, Greg, just before you came in, I think we were just talking about the fact there's a lot of research that shows stock pickers don't pay for themselves. And that it's better to do what Andrew was just saying, that is, you have a strategy that you, at low cost, you track the index you're following, like the S&P 500.
I feel much more comfortable with an index fund than I do with an actively managed.
Especially when returns are so low that, if you're paying 60 basis points or something, in a world in which you're getting 200 basis points gross return, then the management fees eat up a lot. So
Okay. All right, let's see, do we have any
So-
comments from the public before we make a decision? Okay, all right, so Alan, do you want to make a proposal then?
okay, we will go with, what do you say, moderate and index funds.
Okay.
I'll
Everybody
second
in?
that.
All in favor?
Aye. Good.
Thank you very
All right,
much.
now, what number are we putting into our auditor report? I guess we have to-
As soon as I get the actuarial study completed, then I would like to transfer the amount that they say is our liability.
Okay, well,
So it will likely be around the $1.3 million that we have set
Would be
aside.
greater.
Could be,
Would be greater.
it could be less, because our assumptions have changed, because we're gonna have a higher interest rate, and because we have less employees that are
So
active
you're
employees
talking about
right
the
now.
updated version as of 2012, not just the 2011?
I'm talking about the actuarial study that will be released within 2 months. It has a valuation date of 2011 data, and he will consider the assumptions as of today's staffing picture.
all right.
But my feeling is we should put in as much money as we can.
Well, what was all that argument that we had a half hour ago? I thought it wasn't going to do that. You're saying the argument we would update?
Well, no, where we ended up, Greg, was that they were going to take a look at from the current data as well and have like an addendum is where we.
They have to project assumptions out for 30 years, and so the assumptions that they're projecting
Okay.
out are going to include
All
our
right,
current
right.
staffing. And in some assumptions in the past, they've said there's a 3% increase in salaries going forward. We won't have that assumption either.
Okay, so,
So there are some assumptions that they can put into that they can build into their report that will take into account some actions that the town has already taken.
okay, so then there was the second suggestion by Alan that perhaps we hold back some cash and not invest all of it. Do we want to discuss that real quickly?
I don't think that's all of it. We are generating more cash at the moment, and therefore, if we put in 1.3 million, we still will be increasing our reserves based on everything I've seen. And therefore, we are holding back cash, so if necessary, if we have any emergencies, anything else, we do have more.
Well, I think that Alan's point was, and I thought it was an Alan one, was that if the fund, which is going to be funding the healthcare, has a terrible year, we don't have to draw on that fund, that we would have some cash that would be held back, that would still be in a restricted fund. It may be $100,000 or $200,000, which would cover the annual liability for 1 year, so that we would not suffer through any of these turbulent situations.
So if I could recommend, once I get the new actuarial number, I'll bring that to the next meeting, and I can also bring you, like Jim said, the budget is currently setting aside money
Mhm.
for even this current year, which
Right.
will
Yeah.
create that
Right,
portion, I think.
Okay, bring that to us.
Okay,
Bring those numbers to you next time.
all right, and then there was the discussion on the flexibility the city manager has or does not have. Are we going to, do we need to make a motion on that, Deborah, to just make sure that we're clear?
I'll put in the minutes that the city manager would call a meeting of the finance committee in order to change.
An emergency meeting, that means if everybody can't come, then.
Before he wants to change any asset allocation.
Talk to whoever is available.
Right, yeah, okay.
And
Okay,
He meets and confers with at least,
Oh, we can have a meeting,
Yeah.
there's only 4 of us.
And I just worry about the Brown Act. Do we have to, if we have a meeting like that, do we have to give 30 days notice?
no, it's a
No.
special meeting, just.
Yes.
Because there's only 2 councilmen, so we don't have a problem
It's
with
a
that.
special
you and I
meeting, so
don't
it can
know.
be done in 24 hours.
Yeah,
okay, all right, fine, all right.
good.
So I think we're done with this item.
Good.
All right,
Thank you very much.
Thank you.
thank you.
Very much.
Thank you for the data and and the nice
Nice meeting you,
presentation.
Mayor.
Okay. Shall we move on? Discuss the audit planning process.
Yes. So since the council recently changed the structure of the committees, and we no longer have an audit committee, I thought this would be a good opportunity to have the finance committee be a little bit involved in the audit planning process. So I just wanted to go over kind of what happens with the audit. I don't know if you've been introduced to that before as part of the finance committee or not,
I
but.
did it as part of the.
No, 3 of us were
Part
on
of
the
the
audit committee.
Yeah, so you've kind of crossed over. But anyways, at the, in spring, our independent auditors come in and they do interim audit, which is a review of the internal controls. And based on their review of the internal controls, they meet with the finance director and the staff, and they go over any comments that they may have noted or any findings. And they let us know that when they come back for final audit, that they'd like us to respond to whatever those comments are. It gives us time to research things. And then when they come back at final, of course, they test all of the final transactions that we have in our trial balance. So I just provided you with, this is a little bit overkill for you, but this is the memo that they issue to us that just lays out the timeline and everything.
Well, now, wait, make sure I got it, I think I
On the
do, but
way.
I'm not sure which one you're talking about. What's the label?
It's attached to the staff report. So
Is there
there's
eight-
just a very brief staff report that gives the background. Mays and Associates are independent auditors, and so it's called the Interim Accounting Issues Memo,
Yeah.
page,
And there are
1
8
through
pages
8.
of it. Yeah.
And so the first page is just the timeline of what their schedule is. They'll be coming back in October for final field work. They're scheduled to present to the finance committee or the city council, whichever we choose, in December or January when the audit is complete and the financial statements are complete. And then on page 2, they put together their kind of, potential issues that they came up with. There were 3 this year. Management turnover, they just see that there could be potential risk in
Sure.
having interim positions. And so the other one is about building department deposits, and I'll talk about the details of those in a minute. And then they made a comment about our payroll database and kind of our segregation of duties that we have. So that's part of their memo. Then they also put some reminders of what's coming up, new GASBs, things that they'll be looking at. So that's the last 2 pages or 3 or 4 pages of their memo. These don't all apply to us, so I'm not gonna go over them right now. When they come back and present to you, we'll go over the details of what any of these new GASBs, how they would affect us.
But any comments that, you're gonna ask for some comments as to special areas that we want to look into and things like that. I would appreciate it since some of the people who were on the audit committee are no longer here, although one of them's in the room. I think it would be appropriate since they were actually for a full year on the, or more, and we're actively involved in looking at this last audit, and they may have some concerns that they think are appropriate to be looked at, and so I'd appreciate it if you would reach out to those who are also on the finance committee and just see if they have anything they'd like to add.
So,
And
So,
I'm not sure if
so
I
normally
understand.
when the auditor comes in, he's asked for, are there any things you'd like us to special attention to?
Mhm.
And so I'm asking you to contact the former audit committee members and say we're about ready to start this, and we would like to, if they have any specific thing they'd like to add to, that we, you know, we would welcome their input, all right?
Well, I'm a former audit committee member, so I would say one thing.
But you made the you're a survivor, you see. But there's some that like Jim and Rose that,
But what I'm saying is, one of the things we've never really done here is to control inventory, and I don't really see anything in here that indicates it. We've had any, I mean,
well, we wrote that into
I thought we
the
just
purchasing
had a
policy.
discussion.
but not the control. I mean, we should be doing an annual inventory,
Well, I thought we had established that at the previous meeting.
but it should be, the auditor should be saying it's satisfactory.
All right, okay.
And,
All right, okay.
I'm not saying it's not, I'm just saying, you know, we've been selling trucks and we've been selling off our assets and everything else, and it just seems to me that that's one of the areas.
Well, we now have a policy that kind of controls that. But why don't we do this?
Yeah.
Why don't, would it be possible for everybody on the committee, including other people, anybody who has a certain area of concern, can we document those in the next week or two to you? You can pass them on to our auditor?
Absolutely. If you have an area that you think is of concern or specific review, please provide me with that information.
And if you reach out to the former audit committee people that are on the finance committee as well. You know, so there's like Randy, it's Rose, it's Jim Massey, and I think that's it.
Rose is right here, so I would ask her if she's in the company.
Well, we haven't voted
We,
Um,
well, we're not, this committee is not all about pomp and circumstances. Okay, we'll open it up. You're welcome to sit at the table.
Oh, that's fine, I'd like to hear it. Bring back.
Deborah, you said earlier you were going to address this, and it's something I was kind of puzzled by. As of March, this is about the building deposits. As of March 31, I just don't understand this issue at all. As of March 31, 2012, town had building deposits payable in the amount of